Hello, good evening. We are here at OMA Center of Studies. This is a Center of Studies placed in Madrid. Its name is Online Madrid Manuel Ayau, and it is directed by Gonzalo Melian. The purpose of OMA is to teach several subjects specially focused in economics. And we are here in some class of the economics master degree with Larry White. Larry White is one of the most important economists in the field of free banking theory, probably with George Selgin, the two persons who know more about this issue in the world. So it is a complete pleasure to have Larry White with us here at OMA. Welcome, Larry.
My pleasure to be here, thank you.
And well, we are going to think and to talk about some technical issues around free banking theory. And I want to start with the idea and all the problems or all the issues involving the concept of monetary equilibrium. More or less, okay. We know that free banking theories argue that outside money is given, so changes in money demand must be addressed with changes in inside money. The advantage of free banking against currently regulated banking system is that they can not only increase the quantity of inside money, but also change the composition of inside money in order to match the preferences of the public. This is if people want less deposits and more banknotes, free banking can adjust it. I want to start talking about the concept of monetary equilibrium and all the issues surrounding it. Free bankers argue that outside money, this is for instance gold, is given, so that any change in money demand must be addressed with changes in inside money. This is in banknotes and deposits. The advantage of a free banking system against the current banks or banking systems is that free banking would be able to change not only the quantity of inside money but also the composition of inside money. This is if people want more banknotes and less deposits, free banks can adjust that money supply to the preferences. However, one of the objections that starts with this idea of free banking is that if banks can freely issue all the liabilities they want to issue, multiplier could go to infinite. This is, banks could have no reserve and issue as much inside money as they want. And this is especially problematic in the case of banknotes because people tend to get used to manage banknotes and not instead of going to banks in order to redeem banknotes. And if you add that bad predisposition in the part of the public to redeem banknotes, and you add to that fact that you can have credit expansion of banks in concert, so that all banks are expanding their liabilities, their inside money, you may have an over-expansion of money supply with no check, endogenous inside check to stop it. How could a free banking system avoid that problem, that of oversupply of means of payments, because there are no legal restrictions to it?
Well, you raised a lot of questions. So I would say the advantage of a free banking system is not just that the banks can issue money when there's an increase in demand, but they will issue money when there's an increase in the demand to hold bank-issued money, because the profit motive will drive them to do that. And when there's a reduction in the demand for bank-issued money, they will be compelled to draw in the amount of bank-issued money. We're talking about a system in which the public has the option to redeem bank liabilities. They can go to the bank and get gold for banknotes or get gold for checking accounts. And so the banks have to pay attention to their reserve position. When the public doesn't want to hold as much, reserves will be leaving a bank, the bank has to allow its circulation to contract. And vice versa, if people want to hold more banknotes, the bank will see reserves flowing in and it will be in a position to expand. So each individual bank is led by looking at its own reserve position to take the appropriate action. By contrast, a central bank has the problem that you just mentioned. A central bank can overexpand and it doesn't face any discipline until the entire system starts to lose reserves to the rest of the world. So free banking gives banks much more rapid signals and incentives to behave properly. Now, you raise the possibility that all the banks could get together and expand in unison, or maybe just accidentally expand in unison. What that tells me is that the worst case of a free banking system is that it behaves like a central bank. But I think that's not very likely. We expect different banks to have different clienteles, and so when one bank is expanding, another bank is contracting normally. So just if you have 20 banks, it's exceedingly unlikely that all of them will be expanding together. If only some of them are expanding when there's no additional demand for their liabilities, they will lose reserves to the other banks. In the very unlikely case that they just happen to make mistakes in the same direction at one time, then you would have the same problem you have with the central bank that's expanding. But it's much more likely if you have just one issuer, that the one issuer is going to make a mistake, than that 20 different issuers are all going to make the same mistake at the same time. And so it diversifies the risk of overissue and corrects it much more quickly. Now, if the banks get together and conspire, if they explicitly get together and say, let's all act as though we are one cartel, their incentive would not be to expand. Their incentive would be to contract, actually, because what a monopolist wants is a monopoly price, a high price. And for a bank, that means a big difference between what they charge on loans and what they pay on deposits, a big spread. So if all the banks got together, they would say, nobody pay any more than this low amount on deposits, nobody charge any less than this high amount on loans. We'll do less business, right? Monopolists restrict output to get a monopoly price. So if all the banks were conspiring, they would actually want to restrict the output of money below what the public wants to hold. But competition prevents them from doing that, prevents this kind of cartel from being stable.
Yeah, but obviously, I think it's very clear, at least for us, that monopolist issue of bank of issue is not the correct solution, and it is much more unstable than a free banking system. But one of the theses of free bankers is that a free banking system is stable. So my question was directed more, not the contrast between a free banking system and a monopolist banking system, but can a free banking system be stable in the long run if accident, it may be an accident, as you said. One bank can start to overissue, and then as it is overissuing, other banks can join the party so that they can increase the loans to their client at lower interest rates. And in that case, if the public is not aware of what's happening, so that their bank notes are not redeemed at banks, and in the clearinghouse you don't have any adverse clearing because both gross amounts of reciprocal clearings are growing, right. You may have unstable overissue of means of payment.
Okay, so slightly different question. If one bank does expand, is it in the interest of other banks to follow the expansion or not to? And Mises talked about this. He said there may be irresponsible banks, but the well-run conservative banks will do better, will survive in the long run if they don't follow the irresponsible banks. They have a reputation to protect. And if they behave conservatively, then they will be gaining reserves that the expanding bank will be losing. And that will serve their interests better than also joining in the cheap money party, as you put it. So when a bank sees its competitors lending at lower interest rates, it makes life difficult for them, but it isn't their best strategy to join in the irresponsible behavior. They want to make sure that they only lend money to people who will pay it back, and at interest rates that will cover the cost of funds. Right? Banks have to pay interest on deposits to bring in funds. As Mises remarks, in free banking systems in the 19th century especially, the usual complaint about bankers is that they were too conservative, not that they were too liberal in making loans.
Okay, so your expectation is that the free banking system will not overissue, but would keep conservative behavior.
Mm-hmm.
But in that case, you are adding another requisite, I would say, for the stability of a banking system. No, we need not only an institutional framework of freedom,
yes,
which is a necessary condition but not a sufficient condition, but also to have bankers which are conservative enough in order to be prudent and to behave correctly inside this institutional framework.
So historically, some bankers behaved badly, and they didn't survive. And so you can, in early stages of banking, you find bad behavior. Adam Smith talks about the Ayr Bank in Scotland, but the other banks in Scotland did not join in the cheap money that the Ayr Bank was providing, and they learned the lesson of the Ayr Bank. In fact, there was a report written after the Ayr Bank exploded from lending just to anybody without much concern about being paid back, losing reserves and then trying to borrow more reserves. And as Adam Smith put it, they were continually pouring water on the top of a hill, and then, oh, it's flowing down. We need to get some more water to the top. They kept importing gold at very high prices, at high shipping costs. So a report was written which sort of spelled out all the mistakes the Ayr Bank made, and the other Scottish bankers read this report, that this is what not to do. And there were no more Ayr Banks in the next century.
Yeah, I'm just remarking this because then we need not only formal institutions, but also informal institutions in order to do a free banking system to be functional. Although we can say that dynamically informal institutions are created by good formal institutions.
So it will be any system, banking or otherwise, it will perform better as people learn how to do it. But we need freedom for them to learn how to do it and not be straitjacketed or restricted. So with the freedom to experiment comes the freedom to make mistakes, but that's a healthy part of an economy.
Yeah, totally. Well, we're talking continually about overissue, that banks may overissue, but how would you define overissuance?
Well, I would define it in terms of monetary equilibrium. I say an overissue is when a bank has more monetary liabilities in the hands of the public than the public wants to hold in some long-run sense. So what does that mean? It means people, typically if you have more currency than you want to hold, you put it in your bank. Your bank returns it to the clearing system, to the bank or banks that issued that currency. And so it goes back out of circulation, goes out of the hands of the public. Then the bank that issued it finds the currency coming back and the reserves leaving to pay for it, to redeem it at the clearinghouse, and they have to decide, do we reissue it or do we accept the verdict that the public doesn't want this much of our currency? And it only takes a little experience for them to say, we have to pay attention to our reserve position, not let reserves get too low. Because if they get too low, then we're in danger of defaulting.
But precisely at this point, the banking theories has been arguing during centuries. This was an issue that was also raised during the Bullionist controversies, that money demand may not be an exogenous variable, but an endogenous one, so that bankers can partly determine how much demand for money is among the public. For instance, lowering interest rates.
Certainly banks that are not constrained by the need to redeem. So in the bullionist controversy, they were talking about the Bank of England when it was off the gold standard, when it had suspended payments. And so they could issue as much as they wanted and not face any loss of gold. But banks that have to redeem cannot issue money without limit. They will lose reserves if they issue more than the public wants to hold.
Yeah, I was asking this because I'm very interested, and the following questions will be about this topic. I'm very interested in the, I would say, obsession about the relationship between demand liabilities or maturing liabilities and reserves.
Okay.
Because I think that almost every banking theorist, of course, inside Austrian school, both 100% theorists or free banking people, just look or define overissuance in terms of the relationship between reserves and demand liabilities. While in accounting, of course, one of the ratios you use in order to measure the liquidity of a company is the cash ratio. This is the reserve ratio. But no company is just, the liquidity of no company is just valued in terms of cash issue, in cash ratio, sorry. In the private sector, if you want to study the liquidity of a company, you also look at the current ratio, the quick ratio, and of course also the cash ratio. Why don't you think we should use also these ratios in order to analyze the liquidity of the banking system, and even to say that a bank is overissuing or not, not just in relation to the reserve ratio, but also in relation to the rest of the liquidity ratio?
Well, I didn't define it in terms of the reserve ratio, overissue. I defined it in terms of the quantity the public wanted to hold. But yeah, liquidity we typically define in terms of the cash ratio. But you're right, banks have other assets, at least an individual bank has assets that it can easily sell to bring in more reserves. And so exactly what the prudent reserve ratio is for a bank depends on the rest of its portfolio. How quickly can it liquidate that? And not just in good times, how quickly can it liquidate, at what cost can it liquidate in bad times? It's not always easy to sell certain assets if the rest of the market doesn't want them right now. But yeah, liquid securities serve as a kind of secondary reserve.
This is a very good point, because I even want to follow this path, but of course the conversations lead us to unknown places. You said that a single bank, an individual bank may have other secondary reserves in order to be able to attend their maturing liabilities. But you were talking about these secondary reserves as some assets that can be sold in the market against cash.
So if there's a sudden demand for cash,
yeah,
then the bank needs to do that.
But of course, this can work for an individual bank, but not for the whole banking system. Because if whole banking system is selling at the same time, the prices of these secondary reserves would go down, and even more, probably you won't have a counterparty in order to buy the assets you are selling. Don't you think that we should, from a macroeconomic point of view, distinguish between two kinds of liquidity? This is liquidity which is understood as shiftability, the ability to sell in a deep market an asset, and the ability to self-liquidate. This is an asset that is going to be paid in the very short run because the underlying collateral is going to be sold against the liabilities, the demand liabilities that the bank has previously issued, so that the asset and the liabilities of the bank are cleared in the short term?
I've never liked the term self-liquidating because an IOU has to be paid by someone. It doesn't pay itself. But yes, some assets are more prudent than others for banks to hold, and short maturity assets that have a thicker secondary market, assets with a lower default risk. Those are all more prudent and provide a kind of secondary liquidity to the bank better than, say, 30-year mortgages.
Mm-hmm. Yeah, the idea of self-liquidation, that maybe the term is not the more correct, but the idea is this IOU will be paid not against future production of the debtor, but present production, which is currently acting as collateral of the IOU, which is already finished, which already has a large demand in the market, so that the moment when the IOU will be maturing will be the moment when the underlying merchandises are expected to be sold against the bank liabilities which has been issued against the discount of this IOU, so that the IOU will be paid by selling the merchandises against the banknotes which has been issued against the IOU.
Yeah, so that's the theory of real bills as a prudent bank asset, and it makes a lot of sense for a bank that needs to be in a position to expand and contract its short-term liabilities. But it's a matter of degree. It's not that real bills or short-term commercial paper are guaranteed against default. It's just that they're relatively safe. Right? It could be that you've got a 90-day IOU issued by a flour mill, and the demand for flour drops, and he can't pay back. He can't sell the merchandise that he expected to use to pay back the bill. So it's not risk-free.
No, of course. But, for that, because of that, you say that you need the IOU of the real bills needs to be backed by currently existing consumption goods, which already have a high enough demand in order to be expected to be sold.
That makes default less likely.
Yeah.
That's why it's a safe asset.
But I mean, the sense of that is that you are tying money supply to the supply of goods which will be bought or are expected to be bought against that money supply.
Well, I mean, there are dangers in that doctrine, which is historically, people said if a bank only discounts real bills, if it only makes the right kind of loans, we have no more monetary disequilibrium. Everything is great. And then they went to central banks and said, if you, the central bank, only discount good bills, doesn't matter how many you discount, you'll only be meeting the market demand for money. But the market demand to hold money, that is bank-issued currency, is not the same as the demand to discount bills. So when business is brisk, both things go up, but not necessarily one for one. Right? And of course, if you have unbacked money, you have the problem that you mentioned earlier, that Thornton mentioned, that the central bank can, by lowering interest rates, increase the number of bills offered for discount.
But in a sense, you are creating you are attending the transaction demand of money for the goods you are going to sell. You are not attending, in Keynesian terms, you are not attending the precautionary demand for money, neither the speculative demand for money, just the transaction demand, which will be directed to those goods.
So my view is that the transactions demand for money is related to the amount of business activity, but it's not identical with it. You can have changes in money demand around per dollar of income being generated. But yes, as income goes up, money demand goes up typically.
Okay, in order to continue with the conversation, okay, so you agree with the idea that we should not only look at the cash reserve ratio, but
to begin with,
it can be useful in order to begin with it, but in order to analyze the liquidity of banks, we have to have a broader vision. Don't you think that we should not only look at the bank liabilities in relation to the bank asset liabilities, but also to any other short-term IOU from the banking sector that can act as a means of payment, because at some phases, at some parts of the business cycle, there are some assets that start to being used as reserve assets, or even as means of payments, for instance through clearing houses, that get monetized, let's say that way. So you can use as a means of payment not only a bank liability, but also a real bill, a treasury, other kinds of liabilities that then broaden the meaning of means of payments and of money supply.
Well, if in fact you can buy things with a commercial paper or with a treasury note, then yes, I think my view of monetary history is that that's pretty rare. Normally people want cash or something immediately translatable into cash, and it's only in extraordinary circumstances that you see other things circulating. Right? So when in some parts of England in the 19th century, commercial paper circulated as a means of payment, that's because the Bank of England had no branches and other banks weren't allowed to set up branches there. Once they set them up, the circulation of commercial bills went away.
Yeah, but at the end, private bank is just an issue of IOUs, so in principle there's no restriction that any other IOU may circulate as a banknote is circulating.
Well, but a banknote has a par value which it maintains in terms of the basic monetary unit. Any commercial paper that's not payable today has a variable value depending on how far it is from its final payment date. And that makes it usually, certainly in small transactions, inconvenient to use as a medium of exchange because the value changes every day. Currency, the value remains the same every day in units of account, so that's a lot more convenient. So for large transactions, people may find it the additional interest they get from holding these interest-earning assets worth the trouble, but ordinarily, for ordinary transactions, it's very rare to see them circulate.
Yeah, but for instance, you may have clearinghouse liabilities may be used as means of payments in some circumstances among the public, but in other not so extraordinary circumstances, they may be used as means of payments among specialized agents. I mean, among banks, the clearinghouse liabilities are money, but a clearinghouse is not properly a bank. So that it's also part of the money.
Well, it depends on how the clearinghouse is organized. In the United States, the clearinghouse associations were banks. They were bankers' banks. They were banks that only had banks as their deposit customers. They typically operated on a 100% reserve basis, but it was easier for one bank to pay another by transferring its balance on the clearinghouse balance sheet rather than by taking gold out of the vault and taking it across town. When the clearinghouses issued liabilities that circulated among the public, it was because the banks were legally restricted from doing so. So the clearinghouse did on their behalf, illegally in the United States, what the banks were afraid to do because they weren't allowed to do it either. But normally the clearinghouse operates for the benefit of its members. It doesn't compete with them in issuing circulating liabilities.
Yeah, I mean, obviously among the public, what circulates is the means of the liabilities of the agent that specializes in retail issue of notes, and that's a bank at the end. But what I want to say is that just looking at the liquidity of banks in order to have an image of the liquidity of the whole financial system and of the whole economy, it may provide you a wrong image, because even among banks there are other things that are acting as a liquid means of payments or not. For instance, public debt, treasuries, can be a means of payment among banks. I mean, if a bank has a credit against another, it may be paid through the delivery of a treasury. So at the end that's working as a means of payments. Or here in Europe during the subprime crisis, covered bonds backed by mortgages were working as means of payments among banks. So I think that just looking at the banking system doesn't provide you the whole picture of the liquidity of the system.
Well, I would agree with you that it doesn't provide you a picture of the liquidity of the entire system. But I think I would cite reasons other than occasionally liabilities of agents other than banks are used as media of payment. Again, I think that's pretty rare. Years ago, people were Yeager and Greenfield were proposing a payment system in which there's no basic money, there's just assets that change hands. And I made the objection, which I still make, that there's something special about money that makes it very convenient to use as a medium of payment, and that is it has a unique value in terms of the unit of account. It doesn't have a bid-ask spread. Everything else has a bid-ask spread, so somebody has to absorb that. So when you pay with a treasury bill, is it accepted at the higher of the two values or at the lower of the two values? And somebody has to pay the difference between the two. So ordinarily, and the spreads are small, but we're talking about huge volumes of transactions every day. So ordinarily, payments are settled in something that is the unit of account, not is priced in terms of the unit of account. Right?
Okay, let's continue. Because with that we can go into the problem of the relationship between banking behavior and macroeconomic coordination and the business cycle.
Okay.
We can say that interest rates are synthetically the price of time, risk, and liquidity. So as long as savers have every saver has a different preference about time, risk, and liquidity, and as long as different investments have different profiles of time, risk, and liquidity, don't you think that Austrian theory is in a sense oversimplifying the macroeconomic coordination when Austrian theorists talk about aggregate saving must be equal to aggregate investment, and this equality is achieved through the interest rate, as only one interest rate is playing that part of the equilibrium.
Yeah, obviously that's a very high level of aggregation. So we put the supply of loanable funds and the demand for loanable funds on the horizontal axis and one interest rate on the vertical axis. Sorry for those of you this way. Yeah, so we've aggregated everything, but you're right, there are many different kinds of loanable funds, and so there are many different interest rates varying with risk and liquidity, and if you look across the world, the currency in which it's denominated and the inflation risk and features like that.
I'm bringing this issue because at the end you can say, well, Austrian business cycle occurs or happens because the aggregate investment is larger than the aggregate saving. So you have an over-investing problem which turns into a malinvestment problem. But you may have quantitatively the same aggregate investment and the same aggregate saving, so they are equal.
Yeah.
But if the profile and the profile of investments does not match the preferences of savers, you may have that investment is larger at some maturities or at some risk profiles than the desired by savers. Don't you think that's a discoordination that launches a business cycle like the typical Austrian theory is explaining?
I haven't heard that hypothesis before. Yet certainly there's a maturity structure of interest rates, and so interest rate for 1-year loans is not the same as the interest rate for 2-year loans, and we ignore that when we talk about the interest rate. So yeah, in principle, you could have a volume of investment that would be right if the maturity structure of it were right, but the maturity structure is not well adapted. Why that would happen and how that would play out, have you written about that? I haven't.
No, we are.
I haven't read that theory.
We are working here in that, and that's why
I'd be very interested.
That's why I'm asking you in order to have your impression.
I mean, when central banks, as they are today, start to worry about the term structure and say we want to bring down the long-term rate and keep the short-term rate where it is, then they have a potential to distort things in that way.
Yeah, I'm saying this because banks nowadays what are doing is maturity transformation. Not only maturity transformation, really risk transformation, liquidity transformation, but let's stay with maturity transformation, which is easy to think about it. In your articles or in your selling book, you seem to imply that there's no problem with the arbitrage between long-term interest rates and short-term interest rates. This is with maturity transformation.
So it's okay for banks to borrow short and lend long.
Yeah, but if in the aggregate they do that, we have the problem we were speaking before. You have some savers that want to receive future consumption goods, let's say to T equal 5, and the structure of production is focusing in providing them in T equal 20, and that is a discoordination process, in my opinion, much more clearly expressed than traditional business cycle, Austrian business cycle theory.
Well, so investors do have to try to figure out, make their best guess as to when savers will want to dissave. And so there's going to be a sort of trial and error process that aligns the actual structure of production with the maturity structure of desired consumption. So if consumers always save by saying, I'm going to buy a 20-year certificate of deposit that I can't redeem for 20 years, then the signal would be clear. If they keep investing short and rolling it over, then you're right, there's a potential danger. And entrepreneurs have to try to figure that out from the price signals they do have in the term structure of interest rates.
Because I think Austrian business cycle theory is nowadays thought about the spread between market interest rates and natural Big-Sellian interest rate.
Right.
But the problem with Big-Sellian interest rate is that it's not observable.
That is a problem.
Yeah. And I think that if you think on credit expansion as interest rates arbitrage between different time profiles, different risk profiles, matched with erosion, with a process of increasing illiquidity on the balance sheet of banks, for instance, you may have a more realistic exposition of the traditional position of Austrian business cycle theory, because at the end, if you borrow short and lend long, you are decreasing artificially long-term interest rates, because there's no long-term supply of saving in order to match that demand of long-term investment. So you are deploying saving from one point to the other.
It's not necessarily a distortion. It could be. It's based on the hypothesis that the consumers who are saving short are going to roll those savings over. If they don't, then there's a problem, because then the investment is hard to liquidate.
Yeah, that's a very common objection that, of course, you don't know when creditors are going to redeem short-term credits, so maybe you can invest long with short-term saving. But in my opinion, that's very similar to say, consumers want a car in 6 months time, and producers are starting to produce motorbikes. That's an error, that's a mistake. Maybe the mistake can be solved just before the delivery of the car, because maybe they can turn the production in car production, but you have committed a mistake. And if many people commit many mistakes in that same direction, I think that's a business cycle.
Well, so that's the challenge, to give me a coherent explanation as to why many banks would make the same mistake, or many investors would make the same mistake in the same direction at the same time, as opposed to the mistakes being kind of randomly distributed.
That's not a mistake. It's long-term interest rate is 10%, short-term interest rate is 1%. So it's very profitable to arbitrage these two interest rates. And furthermore, if it is just me, the one who is making arbitrage between both interest rates, it's almost sure that there won't be any problem, because even if savers are not willing to roll over every time, I may offer in the future an interest rate a little bit higher, and for sure I will have short-term saving. The problem is if an enough number of people start doing this same strategy, and this is when the yield curve gets flat, you cannot change the structure of production, which is focused or which is directed to produce in 20 years' time, to a structure of production in order to produce in 5 years' time, because, well, all Lachman theory of non-convertible and heterogeneous capital goods, but that's another part.
Yeah, so the challenge would be to explain what is influencing banks and investors such that they're making more of these mistakes than they usually do, or are overcommitted more than they usually are, because you'd think over time they would come to an understanding of how much maturity transformation is actually prudent to do. And you're saying they're doing more than is prudent, or they could, if the public changes its preferences, find themselves having done more transformation than in retrospect it was prudent to do. So the question is, what's leading the entire market astray? I mean, in the standard simplified version of the theory, we have a central bank acting as a big player to distort the intertemporal interest rate.
Well, of course, central banks act very badly in that case, because if you have a central bank which is a lender of last resort and which is not tied by outside money reserves, of course the incentive is just to borrow short term and lend long term and go to the central bank in order to refund your position continuously. But I think that can happen, not in the same extension of course, but that process can happen also in a free banking system. And
well, so I like Hayek's methodological approach, which is that we should try to explain business cycles by first starting in an equilibrium, telling us what the disturbance is that disrupts the equilibrium, and then tracing the economy's path back to an equilibrium. So that would be the challenge for a maturity transformation focused theory. What disturbs an initial ongoing equilibrium? So Hayek had 3 scenarios as to what disturbed his equilibrium. One of them was there's an increased demand for investment, and instead of letting interest rates rise, the banks just expand. I don't find that very coherent. Profit maximizing banks, when they see an increased demand for credit and no increased supply of savings, they should be raising interest rates. His other 2 scenarios, where the central bank is the one that keeps the interest rate from rising when there's increased demand, that makes sense. And the third one is there's no change in investment demand, the central bank just decides to lower interest rates arbitrarily. And that was the story Mises usually told. And that makes sense, although it raises the question of why the central bank is behaving this way. But I mean, that's the challenge, to start with equilibrium and tell a coherent story that as to how the equilibrium gets disturbed.
I don't want to continue much more about it because we have to finish, but I would say that the equilibrium position is the normal yield curve position, and that it gets distorted you go outside the equilibrium when you start with maturity transformation.
But we have that all the time. So how can that be the start of the cycle?
No, I mean, you can have maturity transformations that do not have a very strong effect on business cycle. I mean, in traditional Austrian terms, if natural interest rate is 5% and banks reduce market interest rate to 4.9, well, you have an artificial reduction, but you won't have a real a business cycle that you can observe. I would say that tiny maturity transformations have that effect, and they can be reabsorbed later on by an increased forced saving among the public. Because if you offer higher interest rates later on, maybe some people is more willing to save than before. So you can, in a sense, correct an illiquidity problem with higher interest rates. But that solution may not work when many people has committed that same mistake and you have transformed in a non-reversible way the structure of production.
Okay, so in Hayek's theory, the banks make similar mistakes because they're responding to a common signal. So I need something like that to understand your theory.
The spread. But well, I think we have to finish because we have to have dinner. Thank you very much, Larry, for visiting us here, for discussing with many of the new ideas we have around here. In many ways, you have inspired our theories on how a free banking system works and how they behave, and we are very grateful. So again, thank you very much, and well, we finish here the lesson. Thank you.
Thank you.